Welcome to Kaiser Watch with John Kaiser. I'm your host, Jim Goddard. John, what's coming up on the show today?
Well, we just did the first episode of this session talking about my past experiences in the resource sector with meltups. Now we're going to talk about the meltup that we're seeing in the gold sector.
Why is gold creating meltup conditions?
Well, the most visible meltup that we can see is in the gold producers. On Thursday, my gold producer index was up 229% since I started it on December 31st, 2019, compared to gold, which was up 180%. And today, on Friday, they are all pulling back sharply because gold's uptrend has finally stalled and it's down $100, but that's still around $4,200. The thing with meltups is it takes some sort of visible uptrend that looks exponential to sustain it. And when that stops, as has to happen with something like gold, then all the stocks that are related to that theme, they also sag and pull back. But I don't think we're anywhere near a meltdown in the gold price or in the gold producers. And while the juniors, the ones with ounces in the ground, such as Vista Gold, have done well, they're nowhere near what they should be trading at if you used $4,200 gold and assume that that's going to be the long-term price going forward. Now, let's talk about why we have witnessed this melt up in the producers and gold in the past few weeks. Now, gold breached $3,000 in March, and it sort of traded sideways between $3,000 and $3,400 until it finally broke $3,500 in early September. At the time, my gold producer index was just tracking the gold trend line, but lagging below it. But in August, it finally broke through on the upside. And the problem with the gold producers has been that in the past 6 years, they lost their status as leveraged proxies for the price of gold. And they used to trade at a premium to other base metal producers and all that, because there was always this expectation that gold was going to go up because of fiat currency debasement and so on. And when this was happening in that period of 2009 to 2013, and gold got to 1850, the producers went on an M&A binge, acquired lots of projects. Then gold crashed back to 1150, and mining-related cost inflation really caught up, and they ended up with a lot of misery, and the market became quite contemptuous of them and stopped treating them as proxies for a higher gold price, even though gold had another rally in 2020 as a result of the measures taken to deal with the COVID pandemic. Now, until September this year, and I could feel it, and I've been talking about it and writing about it through Kaiser Research Substack, the market has been haunted by a fear that gold would eventually flame out and retreat back below $2,000. And that was a reason pre-development ounce-in-the-ground juniors such as Vista Gold and Westvault Mining, who are part of the favorites collection, even though they, at $3,000 gold, they would be extremely profitable as mining operations. They ended up just sort of inching up, not really going anywhere. So the market has been in this mindset that this gold price rally will be like all other gold price rallies. It'll hit some stupid number, and then it'll crash back to levels where all these deposits that aren't yet in production will continue to never have a chance at being put into production. And the juniors, which had PEA and PFS economic studies done in the past, and weren't yet at that shovel-ready stage where Westvault and Vista Gold, they were trading at even lower valuations. But in September, gold approached $4,000, and the general expectation was that, yes, this would be the ceiling from which gold price would retreat. And kind of like when gold approached $2,000 in 2011, and then just couldn't make it through that level. It did make it through 2000 in 2020, but then it failed and ended up back below $2,000. So people figured, okay, $4,000 is going to be the top. Although the gold ETFs had experienced inflows during the past few months, and central banks have increased their gold reserve holdings during the past couple of years, none of this really explains the relentless gold uptrend that began in February 2024. Now, this is interesting. There are only weak explanations for gold's uptrend. And of course, that makes people ask, well, how can it continue? Isn't there going to be profit taking and it'll come way down? But this is a double-edged sword of sorts, because it is the absence of a clear-cut explanation for this sustained rally in physical gold that is not paralleled with an significant increase in gold holdings of the ETFs, in particular the GLD ETF, which is still far below the peak that it achieved in 2012. So there's a mystery. Who's doing this buying? On October 8th, gold breached $4,000 for the first time and has now hit $4,300, from which on Friday it has started to retreat. Wall Street investment banks, which at the start of the year were like saying maybe $2,800 was going to be the limit for gold in 2025, are now conceding that a spike to $10,000 is conceivable. At $10,000, this asset class, which 2 years ago was worth about $12 trillion for the above-ground gold stock, or about 6.5 billion ounces. Today, it's worth about $24 trillion. It would be worth almost $50 trillion at $10,000. So that would require some serious rethinking about how the world is allocating its capital. But because of melt-up conditions, it is possible to see gold temporarily spike to $10,000. And the fact that the investment banks are now saying this is possible, they have more access to what's going on behind the scenes. And in fact, what's interesting is that it has forced me to change in my DCF charts, where I show what happens to the NPV range at 5 and 10% for advanced projects such as Vista Gold's Mount Todd. I used to have $4,000 as a fantasy, and I've had to increase the fantasy to $5,000 and have $3,000 become the so-called optimistic price. And that is because I think what's happening is a fundamental reset in the price of gold. That's a real reset. And it's quite conceivable that gold will spike to $10,000, but the real issue is when it retreats, where does it stabilize? Is it going to be between $4,000 and $6,000? Is it going to be between $3,000 and $4,000, or is it going to be sort of somewhere around $2,500? I'm beginning to think that it will be in the $3,000 to $4,000, and that is a big deal because that represents a 150% real gain for the price of gold from $400 in 1980, inflation adjusted, to the present. So why do I always keep referring to 1980? Well, gold was fixed at $35 an ounce until 1972, from 1933 to 1972. And if you inflation adjust 1933 $35 gold to the present, it really should only be trading around $900 if all it did was reflect official inflation levels. Now, in in the 1970s, when gold was made free trading, it ended up spiking to $850 in 1980, and it eventually stabilized at $400 and traded plus or minus $50 for the next 20 years. Now gold bugs didn't really exist before all this, but they came into existence, and they were quite disappointed because they were hoping it would go all the way to $2,000. And but what they didn't initially understand, but later appreciated, was that from $35 in 72 to 480 in 1980, that was a 400% real gain. And all thinking about past gold exploration and mining was based on $35 gold. So any systems that had been discovered that were sort of lowish grade, they weren't even possible to mine with an open pit. The focus was on South Africa's Witwatersrand high-grade reefs, which are ran from 15 to 30 grams per ton, and high-grade deposits in the Abitibi greenstone belts. That's where all the excitement would be for it in terms of gold exploration and discovery. But after 1980, after that miserable 2 years of recession that we had, there began a period of exploration and development based on $400 gold, which resulted in the above-ground gold stock over the next 40 years doubling to 6.5 billion ounces. And that's also part of the reason that gold couldn't go anywhere during that period until the 2000s, when it finally broke out and managed to breach $1,000. One of the things this week that we've seen in the media is the Financial Times. So even though the Wall Street people are starting to take gold seriously, the Financial Times has had a series of articles worrying about these gold producers, which are finally, after gold breached $4,000, people started thinking, okay, it's not going back below $2,000, maybe it'll go back to $3,500, but at $3,500 plus, these producers are going to make an awful lot of money, and they're not really even priced for that yet. So we had the melt-up conditions there. But you saw these Financial Times articles muttering about how these gold producers should not be stupid like they have in the past. They should just do share buybacks and increase dividends and deplete their deposits. And that's still kind of the prevailing mentality. They might still try to acquire each other, but they don't yet have a mandate to acquire the Vista Golds of the world. That will take some time. We need to see where gold does stabilize. But one of the funniest articles that I saw in the Financial Times was one by a Market Insights column by Willem Buiter, who's an economist. And he basically said true stuff, that gold has no intrinsic value because it's not used for anything, and that allocating resources to the mining of it is a misallocation of resources because it doesn't really benefit humanity in any way. And so he said the central banks should seriously consider selling all the gold. And in fact, the central banks are the ones that have been adding to their gold resource. Now, I wondered who this Willem Buiter was, and I checked it out, and he was a member of the Monetary Policy Committee of the Bank of England from June 1997 until May 2000. And for those of us who have been in this sector all these decades, we may remember how the Bank of England listened to this sort of advice and dumped 395 tons of gold all the way down to $251.50, making our misery during that post-BRIEX period until the China supercycle kicked in 2003, a pretty miserable period. So when can we expect the capital to start moving down the food chain? I think it will be next year before this really starts to happen. We need to see gold develop another sideways track. And the reason gold is up at this level, as opposed to like what specific buyers are causing this gold to come up and not be willing to sell and take profits, is a word that the Wall Street guys are starting to use, which is debasement. Now, for 40 years, the gold bugs have talked about fiat currency debasement, and they invoked Weimar Germany, which basically just printed dollars to pay for its, or marks to pay for all their debts, and in Zimbabwe, where they also printed their dollars to pay for their debts, and that was hideous hyperinflation. And yes, gold could go much higher than $10,000, but the debasement that Wall Street is talking about, it's a coded language for the degradation of the American brand that the Trump policies are doing with regard to the rest of the world. And I think it's the rest of the world that is buying physical gold to hedge against these problems that are developing, where America is divorcing itself from its allies, becoming just a player all on its own, and having no friends anywhere. And this problem is not going to go away anytime soon. So I see gold stabilizing somewhere in this $3,000 to $4,000 range. Maybe inflation will come if it does rear its head, if they ever allow the government shutdown to end and start reporting inflation numbers again. We will see gold respond to this. If we get a market correction, such as I fear in the general equity markets, say it loses 35-40%, 1929 style crash, hopefully not with the depression fallout that followed that, export or tariff laced period. If we see this happen, the interest rates will have to be slashed. So this will be supportive for gold. So right now, I see the situation as difficult for gold to retreat back below $2,000, where with costs, of course, staying where they are now, which makes all these gold companies not very, very interesting. Now, during the past week, we also saw silver finally break its $50 high set in 1980 during the Hunt Brothers short squeeze episode. And silver can spike higher, but silver is not like gold. Almost all the above-ground silver stock is fabricated into doing something useful. And if the price of silver goes too high, the byproduct supply from gold and base metal mines, and especially from future gold mines that have a silver credit if gold does hang around here, that will end up seriously harming the price for silver. So what you'll also see is as silver gets too high, you'll see all these fabricated uses become unfabricated and silver come back into the physical market at the same time that the demand for silver or for its various uses stags. So silver can spike up, but you can't sort of expect it to go to $100 and eventually become $100 metal, around which you can base your decisions about whether or not to develop a deposit. Where silver settles out, I don't know, but if it settles out somewhere in $30 to $50, that will also just be fine for me. Gold has the potential to go higher, settle out at a higher level, but until we see it actually do this $10,000 spike, and we don't see the United States falling apart and becoming a Weimar Germany or something like that, that will, be extremely helpful for the resource junior sector. All of this, of course, is harming the outlook for the global economy, and that's why for the base metals, none of this is particularly good news. All these stresses that are happening, and but if you have a gold component to your base metal project, and this is where the copper gold porphyry deposits become very interesting, you're going to be able to get eyeballs onto your stock. So I think the gold melt up that we saw on the producers that's probably over with. We'll see gold stabilize here for a while, and we'll start seeing the capital go down the food chain and start looking at the Vista Golds and price those higher. Then start looking at the West Havens of the of the sort of bottom fish collection, where they have smallish deposits, where if you actually plug in $3,500 gold, it's not such a smallish revenue stream that you get out of that. They'll start properly pricing them, and probably by next year we will see companies like Endurance Gold Corp, which have growing discovery plays and possibly even have an open pitable resource estimate that's at least a base load pile of numbers that the institutions can point to when they explain why they're buying this stock. Then we'll start seeing the gold exploration companies start to attract investment dollars. But the melt-up conditions for the juniors in the gold sector, I don't think those will be possible until this bull cycle is much more advanced.
John, thank you so much for the update.
You're welcome, Jim.
We've been talking with John Kaiser. I'm Jim Goddard. Comments made on Kaiser Watch are an expression of opinion only and should not be construed in any manner whatsoever as a recommendation to buy or sell any financial instrument at any time. Archived online at kaiserresearch.com.